Good afternoon, everyone, and welcome to today's webinar. I'm Rodrigo Gordillo, President of Resolve Asset Management and co-founder of the Return Stack suite of funds. And today we are fortunate to be joined by Corey Hoffstein, the CEO of Newfound Research and fellow co-founder of the Return Stack suite of funds. And if you haven't heard of the Return Stack lineup before, ultimately what this suite aims to do is to unlock the benefits of diversification by really allowing you to introduce alternative investment strategies and exposures into your portfolio without having to sacrifice your core holdings, your favorite stock and bond exposure. Each fund in the suite follows the same simple formula. For every dollar that you invest, we're going to provide a dollar of either a core stock or a core bond exposure, sometimes a combination of both, plus an extra dollar exposure of an alternative asset class or investment strategy. So we launched these funds in the US back in February 2023, and the whole suite has grown up to 850 million in assets, give or take. Today, I'm really pumped to have Corey talk specifically about the latest launch, the US stocks and gold Bitcoin ETF, ticker RSSX, trading in the CBOE exchange, not to be confused with one in Canada that trades in the Toronto Stock Exchange. That's a different thing. We're going to get a chance to walk through the many ways that this ETF works and can be utilized to enhance portfolio diversification and allow for all sorts of different types of stacking opportunities and strategic allocations. And as I mentioned earlier, please do feel free to ask questions throughout over the chat bot. If I see one that's kind of particularly useful at the time that Corey's answering it, I'll go live and ask them. Otherwise, we'll answer them either through the chat or at the end of the presentation. So with that said, let's talk about what return stacking is. So the slide that you're seeing currently is an interesting slide that really defines how historically we've talked about diversification, right? It's always been this process of what we like to say addition through subtraction. In the industry, we disagree on a lot of stuff, but we certainly agree on one thing, all things held equal, that more diversification is a better thing than less diversification. And historically, what we've had to do in order to get that diversification is we've had to make room. We've had to sell a little bit of our bonds, a little bit of our stocks, and add a diversifier into what is considered kind of the new modern 60-40, which is a 50-30-20. And while this may look good on paper, particularly if you look at the returns over the long term, there's a lot of back tests that show that adding these diversifiers are great. In the short run and maybe in the medium run, this can be very painful, right? So in this slide here, what we're observing is kind of an experience of adding a diversifier in the 50-30-20 when compared to the 60-40. So this line just shows the excess returns above the 60-40 when in the first, from 2000 to 2008, when equities were really struggling, bonds weren't doing so great. And if anybody that was allocating during that period would remember, there was a lot of emphasis on emerging market exposure, global exposure, gold, systematic macro, market neutral strategies that were all working because they were outperforming that 60-40, right? That 20% was doing better than the 50 and 30. And so people loved alternatives up until they didn't, right? The second half, what we've experienced up until 2022 is a period where there's only been one game in town where your equities and bonds drastically tended to outperform the diversifiers in your portfolio. So we've seen a bear market in diversification. And what tends to happen is it makes it very hard to maintain a diversified portfolio in the face of this headwind, right? So in the suite, what we're trying to do to solve this problem is, this is kind of really the magic of the whole suite. So we're going to talk about the specific stack today of gold Bitcoin, but I think that if you take anything away from return stacking is that we created a framework for you to understand how we can stack things on top and keep you and your clients invested while giving you those diversifiers on top. And it's a really simple approach here. We've made it so that for every dollar that you invest, you're going to get $1 of a beta and $1 of a diversifier. And therefore, using these as tools for portfolio construction, you do not have to give up your core stocks and bonds that the client knows and loves and appreciates to get exposure to that beneficial diversifier. So On the far left here so if we go to that's right. So on the far left here, to illustrate how this works, you have your traditional portfolio, which is 60-40, right? And this is your kind of traditional benchmark. In the middle, we show that old school approach, what we call kind of like that 50-30-20 that I just described was really difficult to hold on to in the last decade or so. And with the advent of return stacking, what we're kind of showing you can do is you can get to keep your 60 or 40 and then really stack that extra diversifier on top. And this is an example of just a 20% stack, but again, given that we can stack up to 100% on all, like 1-to-1, you can do as much as 100% stack, but most people are looking at the 10 to 30% range here. And so what this does importantly, and it's just hopefully aims to mitigate some of the behavioral issues that come along with accessing these diversifiers, right? So if we go to the next slide, what we find now instead of comparing the 50, 30, 20, what we are doing is doing 60, 40, 20 versus the 60, 40, right? So we get to have kind of a diversification cake and eat the returns too in some ways, right? You see the first 10 years here, when you're stacking that diversifier on top, you're still getting that benefit of having things in your portfolio stacked on top that did better than equities and bonds. But then the second period, where the diversifiers, in this case, we highlight the SOC Gen Trend Index, did low single-digit returns throughout, you're still stacking those over a long enough period on top of your 60-40. So your clients get to live through what they know is a similar return profile, plus something extra that makes them appreciate the diversifiers that you're putting in their portfolio. So ultimately, there's two ways to really look at this this concept. The first is by taking alternative allocations and stacking them on top of your core stocks and bonds. What it actually does is it helps with outperformance, right? So if you have a conviction that whatever you're stacking is going to have excess returns, then you're really adding another unique, hopefully diversifying return stream on top of your stocks and bonds. It's what we say, it's a different way to try and outperform your benchmarks. And by adding something more on top, it's just a different way than just security selection within equities or security selection within bonds. And the second thing that's important here is that you can stack for just simply diversification. And that's really what we've spoken about before when it comes to stocks and bonds. That should be the core element of the portfolio. But as 2022 laid absolutely bare, is that in an inflationary shock environment, stocks and bonds tend to go down at the same time. And so when we look for other options to diversify into, what return stacking can enable is to add different types of diversifiers that are helping, provide different return streams in periods where equities and bonds don't do well. And we see it in 2025 as well. Gold, making new highs, and Bitcoin making new highs as well. So with that said, I would like to pass it over to Corey, and he is going to talk about the practical implementation of this return stacking idea, specifically within the return stacked U.S. stocks and Bitcoin ETF. So over to you, Corey, and I am happy to answer any questions over the chat in the meantime.
Well, thank you for that introduction, Rod. As Rod mentioned, with the whole return stack suite, we are keeping a very similar structure. $1 invested is going to get you $1 of core beta plus $1 of some sort of diversifying strategy or asset class on top. And that structure remains consistent in our newest ETF. This is the 7th ETF in our suite, and frankly, probably one of the easiest to understand. You'll find that this presentation here is incredibly simple. We'll probably get through it very quickly. I think the meat and potatoes actually will come in a lot of the Q&A. And a lot of the conversations we've been having with advisors already about this product since it launched a few weeks ago, there have been some really interesting dialogues around, well, why do we expect gold to go up? What sort of purpose does this serve in my portfolio? Is it a currency hedge? Is it an inflation hedge? Is it a compounder? How much exposure do I need? Bitcoin's really volatile. Gold's really volatile. What should I expect from a product like this? So we're going to get through this presentation pretty quickly. I would certainly urge you to submit your questions if you have any. Rod and I have compiled a tremendous number of questions that we've already received from advisors before this call, and we'll work through those as well. But please don't hesitate to ask any questions you have. So as I mentioned, RSSX, this new ETF that we recently launched, the US stocks and gold Bitcoin ETF, for every dollar invested is going to provide you $1 of exposure to large cap US equities. There is no active strategy being run here. This is meant to be as passive exposure as we can provide to large cap US equities. There's no security selection or anything like that, just pure market cap weighted, as well as $1 of exposure to a gold and Bitcoin strategy. And that strategy in and of itself is meant to be very simple. The idea is when you invest $1 in that gold Bitcoin strategy, it's going to allocate to gold and Bitcoin such that each of them contributes an equal amount of risk to the portfolio. And we'll go through that in a little bit. One of the first questions that naturally comes up is, well, why gold and Bitcoin? And this is where, frankly, this is a great way to make enemies online, is you say to people who are gold bugs, Bitcoin is digital gold. And you say to people who love Bitcoin, well, Bitcoin is digital gold. For whatever reason, it tends to offend both of them. But the reality is, though, from our perspective, we see gold and Bitcoin having very parallel roles and parallel narratives in the investment landscape. Both of them seek to preserve the long-term real purchasing power of investments for their holders. Both of them share a large number of commonalities. What gold benefited from in its physical aspects in many ways were recreated by Bitcoin in its digital aspects. But I think what's really important here, and again, this is probably the number one way to offend people who love both gold and Bitcoin, is in many ways, both of these are what I would consider to be narrative-driven assets. Gold has very limited industrial use. I think about 10% of the mining supply actually goes outside of jewelry and investment to actual aerospace and computer engineering and other, medical devices. Just 10% of the mine supply every year goes to those industrial uses. The vast majority of the supply goes to jewelry and investments, and I would argue a lot of that jewelry is a de facto investment. You're willing to pay up so much because you think it will hold its value. Gold in and of itself as a metal, what ended up being used in certain parts of the world as a base currency because of its really attractive physical properties. It's much more durable, say, than something like silver. It is scarce, but it is highly divisible. As a physical asset, there's no credit risk to it. So it has these really nice properties. It has a very low inflation rate. So all these things about gold made it naturally a great base currency. But it's worth noting it was not the only currency used in the world, right? There were places where seashells were used and all sorts of other physical devices as currency. Gold happened to take strong foothold in certain parts of the world. And in the 1500s, as Europe, really expanded to take over most of the world in its colonization, gold proliferated as a primary currency. But gold in and of itself was not the only currency ever adopted. And the point there being, the reason gold works as a currency is because people accepted it as a currency and they expected other people to accept it. So when I talk about a narrative-based investment, a lot of what gives gold value is our expectation that other people will continue to see it has value. And why do we continue to believe it has value? Because as a society, we find value in the idea of an asset that exists outside of the control of any given nation state. It exists outside any particular political influence. And for a lot of people, that has tremendous power. Gold represents something that they can technically transport with them, that they know they can liquidate almost any currency at any time. At this point, it's got incredibly deep markets that are highly efficient. And as we've seen in the last couple of years, especially, this is something that is supported as being a purchase for macroprudential reasons by central banks. So the narrative that this is an asset that has value as a store of value, continues to take hold. Bitcoin is a much more nascent version of that. I say nascent, it's obviously been around for well over a decade at this point, and in many ways tries to echo a lot of the features of gold. But people always say, well, why can't you spin up Bitcoin version 2.0? You absolutely can. What gives Bitcoin version 1 its moat is that it has already been accepted. And the more it continues to be accepted, the larger its moat gets. In theory, there's no reason you couldn't replace gold with some other metal if we all simply accepted that other metal as having more value. But we don't. We accept gold is what we've all narratively accepted. Bitcoin holds much the same place in the digital currency space. And as it continues to gain further adoption, it will become much more entrenched. And, again, in serving many of the common features of gold, also serves to solve some of the problems of gold. It's much more transportable than gold. It's, you only have to memorize your key phrase. You don't have to carry it around. On the other hand, right, it is purely digital. It isn't a physical thing. And some people have a preference for a physical. So when we were putting this product together, we said, we see the commonalities. We see the parallels. We think there's incredible power in both of these narratives for the real-term purchasing, for maintaining real-term purchasing power and fighting against currency debasement and all these other really interesting features that gold and Bitcoin have exhibited over time that we'll get into in the Q&A. But we don't know how gold is going to perform. We don't know how Bitcoin's going to perform. So the design of the strategy is ultimately going to be really important here. What we find is that both gold and Bitcoin maintain fairly low correlations to the S&P 500 over time, as well as maintain fairly low correlations to each other. And so we think that this combination of gold, Bitcoin, and equities is one that internally is fairly robust and has a considerable amount of internal diversification. We often hear the argument that cryptocurrencies are getting more and more correlated to equities. I think the empirical data doesn't necessarily support that. It certainly seems to be a little bit more regime driven, but long term, we just simply don't have enough data to suggest that it is increasing or decreasing or going to have a structurally higher correlation than, say, gold. What we did find is, 2021, 2022, it seemed to have the same liquidity bubble in cryptocurrencies that equities also went through. And so correlations seemed to spike during that period, but trailing 1-year correlations only got as high as 0.6 and have collapsed much closer toward 0 since then. So in actually designing the strategy, again, what we're trying to do is take that core US stocks and put this gold Bitcoin strategy on top. Now, to do that, if you give me $1, I can't buy $1 of stocks and $1 of, physical gold bars, spot gold and spot Bitcoin. We obviously have to use some sort of futures market exposure to get that embedded capital efficiency. And so what we do is we use a combination of S&P 500 futures, Bitcoin futures, and gold futures to make sure that we're able to maintain that dollar of equity and that combo dollar of gold, Bitcoin. In this graph, what we see in the black line is US stocks. We see the green line is a hypothetical gold Bitcoin strategy that holds gold and Bitcoin in a risk parity allocation. And then gray is the stack on top. We start this line in 2017 only because we think going back earlier doesn't really represent the more modern characteristics of Bitcoin. Obviously, there was huge growth from the early 2011 through 2017 period. Growth we don't think is going to be repeated. It is not necessarily a fair comp for what Bitcoin has the potential to do going forward. That said, when we look at the market capitalization of gold versus Bitcoin being still somewhere around 11 times higher, we still think there's huge potential for that to reach parity over the next decade or two. And so we think that this sort of post-2017 period represents a much more realistic, modern expectation for how Bitcoin should behave. The other thing we've done in this graph, and we'll talk about this a little bit later, is accessing Bitcoin in a capital efficient way has historically been fairly expensive. It's worth reminding ourselves that spot Bitcoin ETFs didn't even come to market until recently. And we'll talk about spot gold ETFs and how those affected gold futures markets. I expect spot Bitcoin ETFs to have much the same impact on Bitcoin futures markets. But historically, the embedded cost of financing in Bitcoin futures was incredibly expensive. Here, we've added a onerous 1,000 basis point per year cost. We think the go forward cost is substantially lower. But just as a hypothetical example, we wanted to be overly onerous in our expectations of what would it have historically looked like to potentially stack a strategy like this together. So how do we actually achieve this? Well, the first thing we do is we get our US equity exposures through a mixture of underlying US equity ETFs as well as US equity futures. So when you invest $1 in this fund, we're going to take 70 cents and we're going to basically buy the lowest cost large cap US equity ETF we can the highest liquidity, lowest cost we can possibly find. And then we're going to use the other 30 cents as collateral for both 30 cents of S&P 500 futures to fill out that S&P 500 exposure, as well as collateral for our gold and Bitcoin program. Now, how does the actual gold and Bitcoin program work? I've mentioned this idea of risk parity. The basic idea is we're going to look at the trailing volatility of gold and the trailing volatility of Bitcoin and weight those exposures in inverse proportion. In this graph, we show a hypothetical example of what that would look like if you simply did it based on the trailing 63 days, or about 3 months of realized volatility. In the actual portfolio, we use a much longer look back horizon. We actually use a close to 500 trading day exponentially weighted moving average to measure volatility. And the reason we do that is because what we're trying to really capture is not the short-term blips of relative volatility, but the long-term transition of Bitcoin's adoption as an asset class. What we find is if we use the short-term volatility measures, because Bitcoin's volatility can jump so quickly, we can end up over trading the portfolio, and you can end up incurring a substantial amount of T costs. Really, what we're just simply trying to capture is the long-term historical vol, and especially how that vol transitions over the next 5 or 10 years between gold and Bitcoin. And so we find using a much longer, slower moving measure of volatility helps us capture that. The other thing we don't do, this has come up a couple of times and I'll preempt a Q&A, is we don't take into account the correlation to equities. And that's not because we can't. We could look at this and say, well, how do we, knowing that we're going to hold $1 of equities, how much gold and Bitcoin should we hold in proportion to each other, such that they each contribute an equal amount of marginal risk to the portfolio, taking that correlation into account. What we ultimately found is measuring that correlation introduces a noise term that doesn't seem to be particularly static over time. And again, it increases the amount of trading and does not move you off the long-term average significantly. And so in trying to come up with a simpler model that would reduce T costs and also be robust to a variety of measurement errors, we went with this longer term, slower moving average of volatility. Again, to simply try to capture that relative vol change of gold and Bitcoin over time. So how can you use this in a portfolio? Well, again, as Rod showed with the hypothetical examples with all the return stacking products earlier, the idea is you can very easily take some of your equity exposure, replace it with RSSX. RSSX will give you your equity exposure back and overlay this gold Bitcoin exposure on your portfolio. And the amount of equity that you sell to buy this ETF directly is proportional to the size of that overlay. So if you sold, say, 20% of your equity to buy RSSX, you would end up with a 20% overlay of this gold Bitcoin strategy. If you sold, say, 40% of your equity and bought 40% RSSX, you would end up back with your original portfolio, but a 40% overlay. And so the sizing hopefully is very intuitive through the design of the product. So in review, the goal of RSSX here is long-term capital appreciation. The strategy that we deploy is that, and again, this is consistent across our entire return stacking suite, is that for every dollar invested, this ETF is going to seek to give you $1 of exposure to large cap US equities and $1 of exposure to its Bitcoin gold strategy. And those large cap US equities are as passively exposed as we can give them, just market capitalization weighted, trying to be low cost, very liquid, very efficient. It's the gold Bitcoin strategy where there's any activity. And here, again, we're just trying to do a slow, simple transition over time, inverse volatility weight the gold and Bitcoin to make sure that if Bitcoin grows in popularity, and we expect that volatility profile to come down, and we could talk a little bit about that Q&A as well, these gold and Bitcoin's exposure will normalize to each other. If on the other hand, it does not, and the vol of Bitcoin spikes as it goes the other way, and perhaps there's government censorship against it, or it gets outlawed, we would expect the volatility profile to pick way up and the amount of Bitcoin in the portfolio to shrink way down in preference to gold. And so again, we think that long-term adoption cycle and the inverse volatility is a very important property of what we've designed here. This is a portfolio that is going to rebalance potentially daily. It rebalances using threshold bands to try to avoid over trading, especially where Bitcoin can jump around so much. We expect it to rebalance sort of every 2 weeks to a month, given the bands, and it will distribute any taxes on an annual basis. With that, Rodrigo, I will turn it over to you for any Q&A. I know we have quite a bit that we got before the call, so we can work through those.
Plenty. Why don't we?
I'll just say before I take a sip of water, again, if you want to learn more about our ETFs, go to returnstackedetfs.com. There's a contact form there. You can get in touch with your local wholesaler, or you can, submit information request online.
Yeah, I can answer some of these too while you rest your voice. Corey and I are both sick. We think we have versions of COVID at this point, but here we are for you guys. So one of the first kind of simple questions here is how often we rebalance. Well, we just mentioned kind of the exponential moving average, and we do trade within bands. That roughly ends up being around once a month, right? So we're keeping the trading costs as low as possible. There's not a lot of movement. It really is about, again, capturing the long-term adoption in between these two asset classes. And as Corey alluded to, if Bitcoin becomes the most prominent way to deal with debasement and currency issues, then it'll get a higher and higher allocation, but slowly rather than suddenly. All right, next question. You detail that every dollar invested seeks to provide $1 of exposure to U.S. equities and $1 Bitcoin. Of what that initial dollar requires borrowing costs excess for the excess Bitcoin gold exposure? I think we can kind of actually just chat about, because you went through how you structure that using, we have the option of using futures. We have the option of using spot everything. Let's just kind of crystallize how we allocate, and then I'll have the website here to show people where they can see the actual holding.
Yeah, so I'll talk a little bit about this. And again, I do apologize for my voice. Getting worse by the second. Sounds like I'm gargling gravel over here. So for every dollar you invest, we're going to take, again, 70 cents of that, and we are going to use it to buy the underlying U.S. equities. And then we're going to have 30 cents in cash. And that 30 cents is going to be used both to buy U.S. equity index futures, as well as our gold and Bitcoin exposure. Now here, because the financing costs within Bitcoin futures have historically been fairly high, and today remain high, several hundred basis points, our preference is to buy as much spot Bitcoin as we can via ETFs. And so when Rod shows our holdings, he will see that we will actually have a spot Bitcoin ETF in there. And we make that trade, that preference to hold more S&P 500 futures versus the Bitcoin futures as much as we can to minimize the overall financing costs of this structure. So our gold is held 100% in gold futures. And then instead of having less S&P 500 futures, we have more S&P 500 futures so that we can hold more spot Bitcoin. One of the questions I've received is, well, why don't you just hold 100% spot Bitcoin? If you only need 20% of the portfolio in Bitcoin, why not put that all into something like, a Bitcoin ETF? And the answer is because you run into tax risks. I won't get into the nitty-gritty details, but there's something called subchapter M. And if you have bad income from a product like a Bitcoin ETF, which are typically structured as a grant or trust, if you get enough bad income coming out of that, it can bust the registered investment company status of your ETF. And that's a very bad thing. And so what we need to do is take that Bitcoin ETF and we put it into a Cayman blocker, which is also where we trade our Bitcoin futures and gold futures. That's how almost all commodity related funds work, by the way, whether you're, managed futures or just a generic commodity fund. But we can only hold so much of it. You can only hold so much of that commodity blocker, and holding the Bitcoin ETF outside of the commodity blocker represents a potential tax risk to the ETF itself. And so there's a lot of that we're structuring around from a design perspective, saying we want to minimize the financing costs, but never at the risk of busting the RIC status of the ETF itself.
Yes, thank you for that, Corey. I mean, a lot of nuance there. If anybody ever wants to see the holdings, they're available on the website. So you can go to the returnstackedetfs.com site and then scroll all the way down here, or go to to top 10 holdings because we don't have many holdings. They're all there, but you can also download the Excel, right? So you can see that we have a gold futures contract for 74%, S&P 500, direct ETF holding for around 70, some E-mini futures for the other 30, and then you have micro Bitcoin iShares Trust. This is the one that the whole spot Bitcoin, so we don't have a lot of the carry issues and so on, right? So everything that Corey just discussed, as it evolves, you can see it there. All right, let's, one of the questions here is, I think this is important. There's a few overlapping questions about the same thing. Unless you want to talk about something else, Corey. No?
Nope, go ahead.
So given the track record of gold versus Bitcoin, what was the thinking of equal risk between the two versus a higher weight gold? So I think we talked a little bit about this before, but when this idea started kind of percolating in our heads, one of the experiments that I did is I said, what would have happened to an investor in gold had you levered up a futures contract, a gold futures contract versus Bitcoin? And what you found was that if you lever the futures contract to the same volatility as Bitcoin since 2018, it's actually outperformed. But broadly speaking, had similar responses to what's been happening on the global macro space. And so what it shows is that they're both valuable. They're both useful as a hedge. And instead of us levering up the gold, we basically lever down the Bitcoin in risk weights between the two so that the maniacs aren't taking over the asylum, the maniac in this case being Bitcoin. And then the second part to this, which is a second question here, in the past 15 years of the second question being, why not allocate more to gold given, how crazy Bitcoin is? Well, because we are explicitly making sure that the maniac doesn't take over, that we want equal amount of impact of the portfolio of the two, and that roughly today, is 80-20. And as Bitcoin becomes less of a maniac, right, then you'll get a higher allocation. And if Bitcoin becomes more of a maniac, you get a lower allocation. So it's a self-regulating weighting scheme here, so that you as the allocator don't have to be worrying about, well, is Bitcoin still working? Is Bitcoin not? You can go home and do your own thing. You strategically allocate, and somebody else in I think what a thoughtful manner using volatility is monitoring the evolution of these two asset classes and weighting them appropriately. Anything you would add to that, Corey?
No, I think that's right. I mean, there are some people who have a preference for more gold. Some people have a preference for more Bitcoin. It will look like not a lot of Bitcoin relative to gold, but it's simply saying, well, Bitcoin is 4 times the vol that gold has. And so if we want them to have the same impact on the portfolio, we need to hold them in relative proportion. And so this is our way of saying, yes, it looks like you hold notionally more gold, but from an actual portfolio impact perspective, we expect it to be 50-50 between Bitcoin and gold. I will say, the last thing I'll say there is we partner with Quantify Funds to bring the stacked Bitcoin gold ETF to market. For every dollar you invest there, you'll get $1 of gold plus $1 of Bitcoin. So if you do want more Bitcoin, that's a highly capital efficient vehicle that you can explore. Ticker BTGD. It's been out for, I think, 6 months now, looking over 30 million in assets. So if you are keen on having a capital efficient strategy that is pure gold, pure Bitcoin, and has more oomph with the Bitcoin, BTGD is one to explore.
Yeah, and that was one of the questions here, how we should think about RSSX versus BTGD. And it's just a matter of how much more weight do you want? That's just a matter of building blocks, right? You have the option of having as much of the Bitcoin building block and of the equity building block as you want. The RSSX, what's been interesting in the last week or so since we've launched is that when you actually take into account the 3 allocations, so the S&P 500, gold, and Bitcoin, I think Paul Tudor Jones came out recently and said, gun to head, what should you be allocating in this environment? And he said equal risk between gold, Bitcoin, and stocks. And we did a back of the envelope calculation, and it just so happens that our existing allocation is very close to that, right? So it's just kind of it seems to be an all-in-one, it could be an all-in-one solution for this environment. But again, it can be used as just stacking a thoughtful, risk managed approach to Bitcoin gold on top of the S&P 500 that you already own. But yeah, there's flexibility there between the two. Okay. So one of the things here that gets brought up a lot when it comes to return stacking, this particular question from Nick is, with the past 15 years or so having very low borrowing costs, how much will the increased borrowing costs affect returns across all strategies? Thoughts on that?
Yes, this one comes up a lot. So I think this goes back to sort of a finance 101 question, which is the idea that every investment asset class or strategy should earn the risk-free rate and then a premium above that. And so the idea with stacking is we're always just trying to add the premium on top of whatever the base stack is. So, right, we would expect gold to earn the risk-free rate plus a risk premium gold. We'd expect Bitcoin to earn the risk-free rate with a risk premium. Actually, that's debatable. We can discuss that. But like trend following, for example, as a strategy, if you invest $1 in a trend following strategy, they're explicitly going to invest that dollar in T-bills and use it as collateral for the actual trading strategy. When we stack trend following on top of stocks or bonds, all we're doing is getting rid of the T-bills and buying stocks, getting rid of the T-bills and buying bonds. So in that sense, our financing cost truly is just what we sold, which is T-bills, for what we bought. And so long as we think stocks are going to outperform T-bills, or we think bonds are going to outperform T-bills, right? We think that it can be accretive. None of that affects the actual strategy, the trend strategy, or the actual return of gold, or whatever it is, right? Another way you can think about this to make life easier, nor the whole Bitcoin complication, is let's say we were just stacking gold. One way to do it is buy spot gold. The other way to do it is I could buy cash plus gold futures. Those returns are nearly identical with how efficient the market is. And we could talk about market evolution and how it applies to Bitcoin going forward.
Yeah.
But those markets are so hyper efficient and similar now that, again, if I've got, T-bills plus gold futures, and all I do is I sell the T-bills to buy stocks, it hasn't affected the gold futures. So the question to ask yourself is, again, do you think stocks are going to outperform T-bills, and do you think gold is going to outperform T-bills? If you don't think gold's going to outperform T-bills, well, you wouldn't buy spot gold or gold futures, right? The excess return is negative. But the reality is the level of interest rates really shouldn't matter. And the other way to sort of come at this is, when you say, does stacking work in this environment versus not? Really what you're asking is there a market timing strategy based solely on short-term rates? And to me, the answer is almost trivially no. Well, not to trivialize, but it's almost certainly no. There's not a simple market timing strategy for any of this based on the level of short-term rates. All of this works as building blocks regardless of the level where rates are, because what we're trying to stack is the excess return.
Yeah. And I think that's a crucial thing. I think the word excess return we use a lot, Corey. And I think it's just useful to just say, like, what is the return above, the cost to borrow? That's the excess return. When we talk about in the industry of the equity risk premia, right? We're not saying that's the return of equities. We're saying it's the return of equities above the cost, above cash, right? It's that excess return. And then if you start thinking about that as a building block, as a Lego block, as we like to use here, right? You got your first equity excess return block, 3.5 to 4.5%, depending on the global stock market. Then you have your term premium, which is the excess return of fixed income for taking duration risk. Then if you think that's going to exist, if you think people are going to get compensated for putting their assets in a long-term borrow, then you can stack that next one on top. Let's see if I can find some other color blocks here. But then it goes on and on, right? Does gold exhibit a positive risk premium? Maybe we can talk about that a little bit, Corey. Is what's the expectation in terms of excess returns for both gold and Bitcoin? We think there is, and we have seen the compensation happen, especially in modern times, where in terms of excess return, you're putting it on top. And what you hope for is, as you put these blocks together, that they all zig when the other ones zag, right? Instead of having to time interest rate movements, you're in essence mitigating against the portfolio level volatility by having things that tend to act differently when those interest rate moves happen, right? And any other strategy, whether it's commodities or systematic macro or managed futures or carry, if you expect you're taking risk and you're going to expect an excess return, then it's a good idea to start stacking. Any thoughts on what I said with regard to whether gold and Bitcoin should have a positive expected risk premium?
Yeah, so this has been actually one of the most eye-opening parts of the research for me, because when you look at academic studies on gold, you will almost certainly find that they all say gold has historically been an excellent way to preserve capital, but not compound capital, right? And I'm sure we've all heard the, however much gold buys you a nice suit at any point in time, right? Like whether it was a Roman toga or you're in the nice streets of London, the same amount of gold would always buy you a nice suit. The reality is when we look at gold, it's gone through many, many, many different regimes, from a currency, right, in antiquity, where it was into pegged to $35 per ounce, right? And there it's more acting like insured cash, to the post-peg period where it was allowed to float. And if you think about what happened in the post-peg period, you basically pushed all of this risk onto the holders of gold. You pushed inflation risk, you pushed policy risk, you pushed currency risk. And the rational expectation would be that for anyone buying gold, that they would demand a risk premium. And so what we actually saw was that pre-peg, there was no realized risk premium. Post-peg, the realized risk premium has been about 250 to 300 basis points annualized. And so, right, again, this is a contradiction for a lot of people who go, this is something that doesn't have cash flow. It really doesn't have a lot of intrinsic value other than this arbitrary value we collectively as a society give it. Why would there be a risk premium? Well, again, we have sort of accepted in general that we believe it has value. We push that risk on to investors. And so it has value. The other thing that seems to give value to gold, if you don't believe the risk premium argument, is what we call convenience yield. And this comes from central banks continuing to purchase gold and often purchase it during periods that gold is selling off. This is what's called the official sector put. We've seen it in particular in the last couple of years. It's been the highest tonnage of gold purchased by central banks, record setting every single year for the last 4 or 5 years, particularly among EM countries who are concerned about sanction risk. That positive demand creates a positive convenience yield in gold and has helped drive the price up. So even if you don't believe that there's a risk premium, you might believe there's positive convenience yield coming from central bank macroprudential purchases. That makes gold, continue to be appreciate price. The other interesting regimes shift in gold, and I'm going to tie this to Bitcoin, is the launch of the spot gold ETFs in the early 2000s had a dramatic impact on the futures markets. Prior to the launch of the spot gold ETF, what tethered futures markets to spot gold was ultimately the cash and carry arbitrage that could be put in place by traders around the globe, right? This is the idea that when the futures are trading too rich to where spot is trading, you would short the futures and buy spot, or vice versa. The problem is when the only way to buy spot is the lease vault space, true Boolean bars, and it's incredibly expensive to do that, to actually lease the vault space, and you have to do it in a certain amount of size. That arbitrage is very difficult to do. When you all of a sudden have a liquid, transparent, low-cost ETF come out, that cash and carry trade becomes much more accessible for arbitrageurs around the globe, and you see that spot futures basis collapse. And so the actual embedded financing costs of gold dropped dramatically post 2002, 2004, when GLD was launched, and continues to remain very, very tight. We expect that same thing to happen with Bitcoin, right? Bitcoin spot ETFs just came out. The Bitcoin cash and carry trade should become much, much more efficient over time, particularly as Bitcoin becomes less volatile. And we would expect the implied cost of financing Bitcoin to go down. And many of the same arguments as to why gold should have a risk premium or gold has a positive convenience yield, we think will continue to get applied to Bitcoin insofar as Bitcoin continues to see adoption. The more adoption it has, we think the more those arguments apply from a logical perspective.
Yeah. This is really answering a bunch of questions here with regards to the cost going forward, right? So one of the questions was, why did you discount 1,000 points on the Bitcoin? You were just trying to be conservative, right? What we're actually seeing contemporaneously now on the Bitcoin futures is what, 4.5%, right? of carry. That is as it happened to gold, as more things kind of play out and more instruments are built around Bitcoin and more financialization happens, you're going to expect that to get lower and lower. So the back test is being conservative. I think we think that going forward, the cost of putting these together and using this type of structure is going to get lower and lower. So I hope that answers that question on the cost of carrying these things on top of a traditional S&P 500. Let's talk a little bit about tax. So there's been a few questions with regard to whether this is a tax efficient structure, as well as the K1s that tend to happen, that one tends to receive with a guarantor trust. Any thoughts on both of those things?
Yes. So to specifically avoid K1s, we trade all the commodities within a Cayman blocker. Again, this is very common for any managed futures fund or any commodity ETF that's a non-K1 commodity ETF. They're trading all their commodities in a Cayman blocker. And the benefit is you avoid all the bad income, you avoid the K1. The downside is any realized gain bubbles up to the fund as ordinary income. And that's why commodity ETFs tend to have poor taxes. You avoid the K1, but you get ordinary income in your gains.
Yeah. Just some kind of ETF-based trading questions. So current implied liquidity of the ETF, market orders to buy have been gappy. How should we think about trading this thing?
Yeah, this is part of the true problem of having a nascent ETF is the market makers aren't paying attention. So if you are a financial advisor and you're looking to place a big trade, this is something that should trade very, very, very tight, right? These are very vanilla, very liquid exposures. S&P futures, gold futures, a Bitcoin ETF that's 75 billion at this point, and Bitcoin futures, they're all very, very liquid. And so if you work with your institutional desk to do an RFQ from the market makers, you should get very, very, very tight fills. If you've never done that, give us a call. We'll help walk you through it. Shouldn't be an issue. If you are looking to trade this, you should be able to trade with a limit order tight to mid. It should not be difficult for the market makers to fill this order. We do apologize. We wish we could artificially create liquidity for you. Unfortunately, can't. It's sort of chicken and an egg problem when it comes to liquidity, but the underlying are so liquid. Anyone trying to do a sizable allocation should be able to get a very, very, very tight to mid fit from market makers.
Yeah, just a little patience, and if it's a large order, reach out. Just one more thing on fees. Are the fees capped at 68 basis points, especially given that you have low AUM to begin with? How is that? How is the management fee going to change, or the all?
Yeah. So ETFs operate with a unitary fee structure. So those 65 basis point management fee is the all-in fee. And then the reason it goes to 68 is because there's acquired fund fees for us buying an underlying S&P 500 fund. So I mentioned 70% of every dollar that goes into S&P 500 exposure or large cap equity exposure. Instead of us buying the underlying ETFs, we actually just buy an S&P ETF that bubbles up as what's called the acquired fund fee. The reason we do that is that we actually think long-term it is cheaper and more efficient to just buy that as an ETF rather than us trading the underlying stocks and hiding that 3 basis points, but probably incurring more costs in our replication with the underlying stocks. So yes, that should be an all-in cost. There's no fee waivers. There's no nothing. The unitary fee is 65 bips, and that is all encompassing.
Perfect. So let's talk about sizing here. We're getting a few questions on, what we consider to be a good stack on top of, equities, on top of bonds, even on top of equities, bonds, and some of the other alternative sleeves that we offer. What do you think would be a reasonable way to think about allocating to gold Bitcoin for the average client profile?
Yeah, let's just start with the acknowledgement that this is spicy. Right? You're taking equities and you're adding gold and Bitcoin. Of all of our ETFs, this will likely be the most volatile, probably around a 20 vol. And so I think for anyone allocating on behalf of others, you need to first be aware of that sizing issue. Before we get into the theoretical, what's optimal, be aware that this thing is going to be volatile day to day just by the nature of what it's holding. And if your clients are concerned about volatile positions, you're going to want to downsize. That said, it being volatile also means it's very potent, right? You don't need a lot to make a big difference. So one of the most interesting use cases I think that there is for both gold and Bitcoin is as a currency hedge. I think both gold and Bitcoin can be thought of currencies that exist without permission outside of any government, right? That's what makes them so, they're decentralized currencies that are accepted around the globe. That's what makes them so powerful. But when you compare to other currencies, right, it's got 5 or 6 times the vol. Gold does at least, right? Gold has a 15 to 20 vol. You look at the IMF's special drawing rights basket, which is the dollar, euro, yen, pound, Swiss franc. I think that basket has a vol of like 4 or 5.
Yeah.
Right. So if you're an investor saying, hey, I've got a whole bunch of US equities and I'm concerned about US dollar debasement, or I'm concerned about underperforming international stocks because a lot of that return comes from currency, you can do a currency hedge overlay, and you would need a pretty sizable amount of actual currency hedge, which is pretty expensive. Or you can do like 1/5 of that with a gold overlay and get the same potency. So it really depends on what you're trying to do. I think this is the sort of thing that easily 5, 6, 10% can be a very potent addition. At that 10% point, you end up talking about having about 2% of the portfolio in Bitcoin, which tends to be, at least in my experience, I'm talking to many financial advisors, hitting their limits of comfortability of how much Bitcoin they want. So, again, you bring that all together, I think that 5 to 10% point, it is potent, it's volatile. Anything above 10%, clients are really going to notice it and how much it moves. Again, it's like a 20 ball thing. So only have that if it's a growth client who can tolerate it. But even for the retirees who are concerned about inflation or currency debasement or all the other reasons why you might include gold as a diversifier, I think gold or Bitcoin as a diversifier, I think that 5 to 10% range is prudent.
Yeah. And I think just to add to the currency hedging part, I think what people don't, there are a bunch of currency hedge ETFs out there that are trying to minimize the impact of global currencies, but there's a cost to those hedges, right? There is an actual, that's a legitimate cost to hedge. I don't think people realize. You're basically wiping out any of the returns that you would get from the currency that you're trying to get exposure to. So gold, Bitcoin, if indeed they have a positive risk premium, it should be a decent hedge that actually has positive expectancy. It's something to consider as you're thinking about it as a currency hedge. With regard to the volatility, yes, again, from a 1+1 like single solution, it is very spicy. As Corey alluded to, though, as part of a portfolio, if you're adding that 5% allocation to 10% allocation, and then you add up the volatility of the, let's say, 60-40 versus 60-40-10, the overall portfolio volatility doesn't budge that very much, right? But it does, like we always talk about how return stacking done correctly can help increase returns, but not necessarily like you're stacking returns, but not necessarily stacking the same amount of risk, right? So if you think about stocks at 15 to 20 ball, gold, Bitcoin from 15 to 20 ball, that adds up to 40. You're not getting 40% ball here because of the non-correlation between those 3 asset classes. Your volatility is more towards the 18 to 20 ball, right? So it is spicy, but the diversification should make it palatable over different cycles. So just make sure you're not putting too much tracking error in your portfolios so that you're not forced to redeem this allocation. Okay. So yeah, we talked about like spiciness and people asking about drawdowns. Of course, when you have a 20%, I've talked about this as well. If you have a 20% standard deviation strategy that is reasonably normally distributed, you should expect 3 standard deviation. This is a decent heuristic, which is if it's 20% volatility, and let's say it's a Sharpe ratio of 1, it's 20% return. 20 minus 20 is 0, minus 20 is negative 20, minus 20 is negative 40. So what should you expect is a good possible heuristic? Probably a bit more than that. At some point, once every 7 years, right? And so again, talking about the spiciness, but this can happen in equities, this can happen in gold, this can happen in Bitcoin. Like when you combine them together, this is something that is in the cards, and hence why the kind of the 5 to 10 allocation makes sense. Okay, I think we've answered all the major ones. Let's see, target volatility, Bitcoin gold equal to gold volatility. Yeah, Bitcoin levered down or some mix between the two. So we haven't levered everything down to gold volatility. We've just done an equal risk allocation between gold and Bitcoin with the $100 that we have left on top. So that is slightly higher than gold and significantly lower than Bitcoin. I think we have a couple more minutes left. We're working on a bunch of articles and white paper on gold that I think would be very useful for people who are interested in understanding why Bitcoin, why gold, that are coming out soon. So keep an eye out for that. Sign up if you want to sign up to our newsletter. Go to returnstack.com and you'll see an option there to subscribe at the bottom of the page. If you're an investment advisor and want to look at model portfolios that we run on the Return Stack site, go to the model portfolio section and register. We'll have to have an approval process, but then you can get access to see what we're kind of putting together in terms of model portfolios. Corey, is there any parting words here for the audience on this ETF?
My parting words would be, I have probably been a gold skeptic for my entire career. And it really took digging into gold to understand how gold has changed over time. I read all the papers on gold. I saw all the academic evidence that suggested it had zero real return. It took a tremendous amount of effort from Resolve's team and my team and myself digging into understanding how these assets really have changed over time. And so if your perception of something like gold or Bitcoin is that it should have zero real return, reach out, let's have a conversation. As Rod mentioned, we have this white paper coming out. I think there's some pretty compelling evidence that a lot of the academic studies overlook the very distinct regime shifts that have happened. And the gold that you buy today in 2025 is not the same global gold concept you would have bought in 1925 or 1825 or 1525. They are just different things. It's the same physical metal. Nothing about the properties of it have changed, but the investment properties have changed dramatically as it has matured. And I think that's going to happen with Bitcoin as well. So if you find yourself as someone who's a gold skeptic thinking, well, how could I use this? There's no cash flow, right? This isn't a traditional productive asset. Set up some time to have a call. Let's have a conversation, because I think there's some really interesting aspects of how gold can fit in a portfolio that really, as an investment professional, surprised me as I really dug into it.
Yeah. And we had to bring Corey biting, kicking and scratching into the whole gold thing, but to me, it's evident even from a portfolio construction perspective. Like, let's assume that there's a zero rate of return, right? The fact that we can stack a zero cost hedge on top of your stock and bond portfolio, even that would be useful, right? If you're not losing money on it, then you have something that we've empirically seen, and we can just behaviorally just ask ourselves, when is gold likely to do well? Like, just intuitively, when is gold likely to do well? And then you look at the empirical evidence and you'll see that, yeah, your intuition was probably right. And so just the understanding of the intuitions when gold does well, if you can stack it on top, even if it does provide you zero returns, which we think it'll provide a positive risk premium. But even if you are a skeptic, from a hedging perspective, I think it makes a ton of sense. So those are my parting words. Corey, thank you for struggling through the presentation, even with
Thanks for everyone listening, struggling through my voice. I appreciate it.
We'll get AI to fix you over the last hour. But thanks everybody for attending today. Thanks for your very thoughtful questions. If there's any further questions that you guys have, again, go to returnstack.com and click on the team section or the contact us section, and just book a time with one of our sales representatives, and we can help you out with any legal questions about the product, about the suite, or about gold and Bitcoin. Thanks again, everybody, and we'll see you on the next round.